Today I have 13 trading strategies and signals for you that are super powerful. And the cool thing about the strategies that you're going to learn today is that you can mix and match them, which means that you can take specific rules, signals, or criteria from one strategy and then add it to another one, and so create your own personalized trading strategy that makes sense to you, that you feel comfortable with, and that supports your way of looking at charts and finding trades. Let's start with the 1, 2, 3 pattern, and this is a pattern that I've been trading for many years. So when we look at a chart and we're looking here at an uptrend, we can see the natural rhythm, how the trend is unfolding. And the most important criteria in an uptrend is that you're making higher highs and higher lows. And when this pattern is broken, that can often signal a trend reversal. However, the problem that many traders have is that they get into trades too early and then they run into fakeouts, pullbacks, liquidity runs. So what we see here at the top is that you have your fakeout. The market violently then breaks the first time a swing low and signaling a potential trend change. However, what I've come to realize over the years is that instead of taking the initial breakout, you are much better off long term to wait for the point 3 to form. The point 3 is located above the breakout that we are seeing here. So the market often pulls back inside of the pattern. It doesn't make a higher high, which is very important. So the point 3 is much lower than the point 1. You can also add other criteria. You can add a Fibonacci, you can add a pivot point, or you can look for fair value gaps here somewhere in this pattern and the move that led to the breakout. The most important part about trading the 1, 2, 3 pattern is not to get in too early. And again, that's where a lot of traders go wrong. So we see that the price is pulling back here above the swing point, above the break point. And what is really important, you want to see a strong momentum reversal. You want to see that as the price is pushing into this breakout area, you want to see that the market is pushing lower aggressively. You want to see a very strong red candle. That red candle should typically be much larger than any of the other candles that you have seen in this move from point 2 to point 3. The stronger the momentum reversal, the stronger the red candle, the better the quality of the overall signal is. And that point, that's where you will get short. Another great thing about this is that you get a much better reward to risk ratio than if you would take the breakout here, because you have a much higher entry price, which is better if you want to go short. And also your stop loss is fairly small. You can look left, target a previous support and resistance area. And then as the market moves lower, you can see that's when the real trend starts. The trend only starts after the price has put in the point 3. If you missed the initial entry, you could have had a second entry point here, another significant red bar that brings us back below this breakout area. And that could have been your second entry, or if you've missed the first entry, that could have been the entry that you can choose as well. The 1, 2, 3 pattern is super powerful, and I would recommend to test it out or at least start paying attention to it. And we're going to learn other tools in this video that will help you understand the 1, 2, 3 and the reversal structure much more efficiently as well. Let's move on to the ABC Fibonacci. And I love Fibonacci trends and extensions because Fibonacci's help us understand the rhythm of the market with very specific extension levels and very specific ratios. So what we see here is that we are coming from a downtrend, so the price has been trending lower. We have here at the bottom a triple bottom, and then the market is starting to break swing highs. So we can see here the market has broken a swing high, and then here has been the real breakout that is signaling a trend change. Why is this breakout different? The difference lies in the strength. Here we can see the first strong bullish trend wave that is going higher. And that first strong bullish trend wave that's much stronger than any bullish move that we have seen here in the past is a good signal that the trend is really unfolding now to the upside. What we do now is with the Fibonacci, we look for this ABC pattern. A is the origin for the first trend wave, B is the endpoint of the first trend wave, and C is the end of the retracement wave. What we then do is we apply our Fibonacci tool from the low of point B to the top of point C. What we then get is our retracement level. In this case, we have a 61.8 retracement, and you can see how perfectly the market is respecting the fib. The more precise the respect of the fib level, the better the quality is. Then what we do is we're looking for bullish opportunities into the trend direction, and we can use our Fibonacci extension levels for target placement. It's very, very common to see the market push into the 161.8 Fibonacci extension after the 61.8 retracement. That's the natural rhythm how the market moves. And you can see the market pushes into the 161 and has immediate resistance here. And one of the reasons why this is happening is because a lot of traders are gonna take profits here. Whether or not they're gonna use Fibonacci extensions or not, that doesn't matter. What happens is that the trend has been going on for quite a long time, so that the buyers that have bought the price up here are sitting on profits that they are now more likely to exit and that they're gonna realize the profits. So naturally, you will often see retracements and you will see reactions at the 161.8. So the ABC pattern is super powerful when you're trying to trade trends and you want to look for the perfect exit point. Next, supply and demand. I love supply and demand, and if you've been following my YouTube channel, you have seen many supply and demand videos. So let me show you a very simple, very, very powerful way of trading supply and demand. And we're going to use the concepts that we have discussed in this video already, so you can see how this all fits together. So when we look at a chart like this, we want to identify the origin of the trend. The price is here clearly in an uptrend. And where did this uptrend start? Here we have a sideways consolidation that the market traded in for multiple days. And then we have this super strong breakout out of this range. And at the origin of the breakout candle, you will often find very strong demand zones. The stronger the breakout and the smaller the consolidation before the breakout, the better the demand zone is. What we then do is we just simply wait for the price to get back to the zone. A very important thing to understand here is that you don't trade the touch blindly. So just because the price is hitting the demand zone, it doesn't mean that you automatically are going long. You need to wait for more confirmation because you're going against this recent downtrend, and that is more risky if you don't wait for the right confirmation and you're not seeing signals that actually tell you that the market has a likelihood of moving higher here. What we can do is use our break and retest, the Fibonacci ABC or the 1 to 3 pattern. So as the market has moved into demand zone, what has happened is that the market pushed higher, moved lower, and then confirmed the breakout out of a recent high. You can see here was a high, and that was a very strong breakout sequence. And then you can see you have your point C here. So A would have been here, B would have been here, C is here. And then if we apply a Fibonacci to that, again here A, B, C, you can see the point C is at the 50 retracement level. We get a push into the 161 area, which also coincides with this supply zone. It's not a very strong supply zone, because the market dropped only a little bit. But you can see if we stack confluence factors, the supply zone and the Fibonacci, that becomes a very reasonable target. And you can see how this market is reacting to this area. Clearly the price overshot the level here a little bit, but then pulled back immediately. So there's a high chance that the market is not going to continue higher. And that is how you can combine supply and demand with the 1 to 3 or the Fibonacci ABC to trade those moves away from demand zones. Triple taps are super powerful price patterns that help us understand when a trend is slowing down. That's why it's called an exhaustion pattern. What we have here is an uptrend, and in the uptrend here on the most recent ride, let's examine the price moves to the upside. So the price pushed higher 3 times. 1, 2, 3 times. And if we just measure the distance from the bottom to the top of each swing move here, we see that the swing moves get weaker. Here in the first push from the bottom to the top here, we have a 70 pip move. The second time the market moves lower and shoots back higher, we have a 50 pip move. And then here on the final part, from here to here, we have a 30 pip move. And this tells us that the bulls are getting weaker. The bulls are not as strong anymore. In the past, the bulls are super strong. Here the market moved higher a lot, still quite a bit here on the third push, then here smaller and even smaller. The price is almost not able to clear highs here. We more or less have a double top here at this point. And that shows us that the market is exhausting and the market is rolling over. You might look at here on the left side and say, this is already here a big push. Why aren't we focusing on that? And this is what we call a V-top. The market shoots higher and lower. This is not an orderly trend reversal. And what we have here is a slow momentum shift. And that is often how long-term trends shift. The Forex market is the biggest market in the world. And to turn a trend from an uptrend to a downtrend, it does take time. It doesn't just happen in one go. And when you see those gradual long-term changes in trend structure, those are very meaningful signals. What we do is that, again, we wait for the market to shift, just like we did in the beginning with the 1, 2, 3 pattern. What we have is that the market is now breaking here a swing point. Here we have breakaway momentum. For aggressive traders, that could have been an entry. I, again, would have waited for a retest here, which didn't happen, so there was no initial trade. But what we then have later is a dirty retest. So the market clears another swing low on the way down, confirming further that we are in a downtrend, pushing higher, freeing up all of the liquidity from the breakout traders who got in here. So a lot of traders will short here with a stop here. The market pushes into this and then reverses lower. And just like what we've seen in the 1, 2, 3 pattern in the beginning, you want to wait for strong momentum come into the market. Here, a very strong candle that is going into the trend direction that we want to trade. At that point, you have a very solid entry here. We have a lot of confluence already on our side with a triple tap, the strong selling coming in here, the breakout into a new low, the retest with the rejection into new lows. And at that point, you have a high probability short trade. And then you can see the market kept going and going and going. And the trend really started unfolding after the breakaway momentum. So those are great ways how you can trade the market if you start seeing a triple tap. So once you see the triple tap with the exhaustion, that tells you to be very cautious about long. And it's probably a much better idea to get positioned away from the triple tap into the new trend direction. I also just released a new free ebook which you can download right away. You can go to the link in the video description or in the comments, and then you can download the ebook which contains 22 new trading strategies. There are dozens and dozens of screenshots waiting for you, detailed explanations for the best trading strategies that you can apply to all the markets and all the time frames. The cup and handle pattern has been traded by some of the best traders of all times with making millions and millions, and it's a super strong pattern that still works today. So what we see here is that the market is in an uptrend. The market cleared here the previous resistance. It worked as support. The market moved higher, tested the support once again, and then is back here at the high here. So the price is back at the highest high. But we want to observe the reaction to the resistance here. And what we can see is that whereas the first time the market hit this price level, there was a very strong sell-off. The market came back to the area, and the next sell-off was very weak. At that point, you can see the market almost didn't pull away at all, and the price was really gravitating and sticking to this level. So the first part is the cup part. The second part here is the handle part. And that tells us that there's a lot of buying interest, and all of the sellers who were interested in driving the price down here previously are not in the market anymore. And that foreshadows a lot of buying interest here. We have the breakout, and one of the keys about trading the cup and handle breakouts is you want to see a volume spike. The breakout candle should have significant volume, and it should show a significant shift in volume. Here you can see previously, as the market moved here into the handle part, the volume was moving lower, so there was not a lot of interest in this handle part, and the sellers didn't have the majority here. But now the volume is spiking as the price is breaking out. And at that point, you're looking at a high probability entry price. And you can see a very quick move to the upside, easy take profit here on this trade, and a very good trade outcome after this. And if you've watched other videos of mine, this is also a pattern that could be called a breakout buildup, because we are looking at a breakout and it's building up here. It's building a lot of pressure that is just boiling here underneath the resistance. And then once it's released with high momentum and high volume, that's then where you're looking at high probability trading scenarios. Let's try to understand breakouts and fakeouts, and how do we distinguish between a breakout and a fakeout. And that's very important because a lot of traders are struggling with breakouts and they often get caught on the wrong side. So we're looking at a downtrend here clearly, and the market is breaking out, right? Possibly. As I've shown you in this video a few times already, it is very important that we wait for the retest. We don't want to jump on the first breakout, especially if you're seeing that the price has already trended lower. We call this a mature trend. A mature trend is a trend that has been going on for a while and where you see you have multiple trend waves. So we want to see for a retest or a breakaway. But here the price immediately slaps back higher. So we have a breakout, and within 2 candles the market is inside of the pattern. At that point, I wouldn't say this is bullish. I wouldn't call this a fake out, because there's still quite a high chance that the market is going to do a 1, 2, 3 pattern and move lower. But at that point you have options, and that's the cool part about looking at charts this way. I would say we are now in a neutral state. The market is not bullish, the market is not bearish, but it's potentially setting up for one or the other. And both trading plans would make sense. If the market clears the lows here, we have a 1, 2, 3 pattern in a trend following approach, right? So if the price trades back below that, this one looks like a 1, 2, 3 pattern and we have a high probability short. But if the price gets above this, we have a fake out and we have to break into the first higher high. And that would then mean a trend reversal. What we have here is a 1, 2, 3 pattern to the opposite side. So this is now a fake out because the price has confirmed the first higher high and the price didn't follow through on the breakout. So we have point 1, point 2, point 3, and then we're looking for a continuation. You could also add a Fibonacci from here to here. You have your retracement, and then somewhere around here, you're going to have your Fibonacci extension target. And you can see the price retested this once again and moved higher. And this example should give you some ideas on how to look at breakouts in a clearer way, where you're not only looking at one criteria, but you're looking at the whole story. You're not only trading the breakout, but you're waiting for the reaction after the breakout, which is really the key here for chart analysis. You don't only want to look at one thing, you don't want to be one-dimensional, but you want to have multiple confluence factors, and you want to look at the right trend sequence to find high probability trades. I love trading divergences. I've been trading them for over 10 years and they are super great and they help you understand trends on a different level. So let's take a look at this chart, and I've added the RSI. It's the 14 period, so this is the default setup. And when we look at this chart, if we don't have the RSI here, we would only see that the market is moving higher and we are in an uptrend. But once we add the RSI to the mix, we can see that although the price is making higher highs, the RSI is giving us a warning signal, because the RSI high here and this high, they're moving lower. And I made a video on the RSI exclusively on my YouTube channel. The RSI is a trend strength indicator, so it shows you how strong is the trend. And if the RSI is moving lower, it means that the trend is slowing down. So by looking at the RSI in combination with that, we know that the trend is slowing down. How do we know that if we don't have the RSI? We could use the same principles like what we had done in the triple tap example. From here to the first swing point, we have a very strong trend push. From here to here, a much weaker trend push. And after this trend push, the market didn't follow through quickly. Here it only took the market 6, 7, 8 candles to make a new high. Here to here, it took the market more than 10 candles. And then the next time the price moved higher just a bit. So this shows us the weakness at the highs. And the length of the corrective phase coupled with the weak push to the upside, only pretty much 2 candles here, that's what the RSI is picking up from your charts. And that's why the RSI is confirming that the trend is slowing down. Again, just because we have an RSI divergence, it doesn't mean we are going short. We are waiting for the price to make a change of character, which means that the price is breaking into a fresh low. Again, we don't trade the breakout, we wait for the retest. The retest is coming, the price is rejecting previous support as resistance. The market is then starting to move lower. That's where we get in high probability short setup. and we can trade with the trend that is unfolding here. We have the confirmation from our divergence that the uptrend is slowing down. We have the confirmation of the price breaking a previous higher low, that the market is even turning now. The retest is holding, so the price is not able to push higher. There's no more bullishness in the market at that point at all. And then it's just about waiting until the price is hitting our target and moving lower. Flags are some of the most important trend continuation patterns, and let's explore them. What we have here is a strong downtrend, and then here we have a flag pattern. And yeah, the flag pattern is used by using trend lines, but there's much more to that. So let's try to see what we can find here. And we want to look at wave strength and wave weakness. So here we have strong selling, right? In a short period here, the market moved lower significantly. The market dropped here almost vertically down. The green area is our corrective phase. The corrective phase here shows a move against the trend direction, but what you can see is that the price only maybe even halfway pushed into this selling period, so there's not a lot of bullish pressure behind that, and it also took the market quite a long time to make this little bullish move here. So we have strong selling and weak buying. And now it's only about waiting for the market to break out of this trend line and to break out of the flag to give you a continuation signal. We can add a pivot point to that. This is the pivot point indicator. If you are going to TradingView, it's called pivot point standard. And here this is the central pivot point. And what you can see is that the price is really struggling here with the weekly pivot point. That's a great confirmation signal here for our short idea. When the price is not able to break above the pivot point and the pivot point is holding as resistance, that shows us that the bullish side is really weak. And there's not a lot of bullish interest. Each time the market pushes into the pivot point, it gets rejected here and here as well. So even more confirmation that the bearish side is in control. We don't trade the breakout, but we're waiting for the market to push back here above the zone. The push here happened here. The market is retesting the trend line. The breakout initially didn't succeed. We had to wait here for this stop run, and then the trend unfolded to the downside. So again, you can see how this all is fitting together. We're looking at wave analysis. We're using pivot points. We're using trend lines, break and retests. And that's how we can then build a very sophisticated and multi-layered trading plan. Next is the liquidity run. And we have taken a look at this pattern in this video in a few ways, but I want to dedicate the own space for it. So what we have is the market moving lower, and then we are building this pattern. We have a higher low, so we could also connect here the swing points to form a triangle. But the key here really is the resistance. A lot of traders will trade the breakout, but in my experience, and I've been trading for 16 years, this is a very big mistake. Breakouts rarely work these days. Instead, what you do is that you're looking for a stop run. So when the traders trade the breakout here, their stop will be somewhere here, maybe underneath the swing point, maybe underneath the resistance, or maybe all the way below the swing point. However, what you want to do is you wait for the stop run. And again, you want to be patient. Just because the market is pushing back into this area, it doesn't mean that you automatically go long here. You want to wait for strong buying come back into the market. You can see that here the price pushed into the zone and away from the zone. So you could have had your first entry here, and that first entry probably didn't work out because there was a second push. But the cool thing about that is you get a second entry opportunity. So even if you get taken out here by the second push lower, you have another strong bullish reaction here, and that could have been your entry as well. And if you missed that entry, you have a third opportunity. The market is now again pushing into the zone, making a higher low, and a very strong breakout here away from this area. So the key to trading those liquidity runs and stop runs is that you want to see strong momentum into the direction that you are trading. So in that case, you want to see strong buying here, strong buying here. And this pattern is so universal. You'll find it across all time frames, across all markets. Stop run and then strong buying. And once you start paying attention to it, you will see this pop up everywhere, and you will start to recognize the pattern of it, and you will be able then to handle those types of scenarios. I'm super passionate about demystifying indicators. And the stochastic indicator is an indicator that is very popular. However, it has been used by most traders incorrectly. So let me show you a better way of using the stochastic in a riding approach. So when traders apply the stochastic to their charts, and this is a higher time frame stochastic, what they do is that as soon as the market moves above 80, they're looking for reversals. But once you understand the formula of the stochastic, you will understand that the stochastic is a trend following indicator. So a high stochastic doesn't show that it should be reversing. A high stochastic shows that there's a strong trend and it's most likely going to continue. So what we have here is a breakout out of the range. The market has the resistance area, broke out. You have the dirty retest here. The market moves lower, and then here the stochastic is entering the above 80 area. So at that point, you have the breakout, you have the retest, and you have the confirmation from your stochastic that you're looking at a very extremely strong trend. And what happens is that if you get in here on the break-in retest, as the stochastic is above 80, and you can see the stochastic stays above 80 all the time, giving you always the green light to stay in the trade. So it's a great confirmation tool that can give you a lot of confidence. You would have been able to ride this trend for many, many days, and you would have been able to capitalize on this big trend by using the higher time frame stochastic, not as a reversal signal, but as a confirmation. And that's the way that the stochastic was intended to use, because that's the way the formula is put into the stochastic. It's a confirmation signal, not a reversal signal. Let's take a look at channel riding, and this has been a very popular strategy that I've talked about in the past on this channel. So what we're doing here is we're adding two moving averages. One is applied to the high, one to the low. It's both a 50 period moving average, and that gives us this channel. What we see here is that the market is having a divergence. The market is breaking above the channel and it's retesting it, right? There were some periods here in the past where the market broke above the channel, but immediately fell back, broke above it, fell back, broke above it, fell back. Here we now have a divergence, the break above it, and the retest. So the market is not falling back, and we have this area of confluence, previous support turned multiple times into resistance. At that point, we know that we have a lot of interesting signals that tell us that something is changing here compared to the past. And that's where it all comes down to when we're doing chart analysis and trading plans. We want to analyze and find clues that the market is changing if we're looking for trend reversals. So what we do now is we wait for the market to break above this. What we have here, right? The market is now able to break above the resistance. We're testing as support. That's where you then find your breakout trade entry, or your retest entry rather. And then you can see the market is moving higher. The moving average channel is acting like a confirmation signal. As long as the price is staying above the channel, that's when you can stay in your trade. And then when the price is closing below the moving average channel, that's typically then where you want to exit your trade and start looking for trend reversals. Here we have the same pattern, right? The breakout below the channel, the retest, the breakout below the swing point, and the trend is unfolding to the downside. So you can see that the pattern is repeating itself, and in the trending market, the channels can be a very great asset for your trend analysis. I love trading the daily high-low, and if you're one of my students and one of my mentees, you have seen use this daily high-low many times. So when we look at this chart, what we can see is that we're in an uptrend. The market started to roll over slightly, but we don't see a lot of selling. The market is here in this top pattern. And what I love to do is add the daily high-low. When you're going to TradingView, you just search for daily high-low, and then this will give you this indicator. The daily high is this area, so it's the high of yesterday's price action, and this is the low of yesterday's price action. And this gives you this great channel that helps you understand price action on a very different level. So what we see here is that the market is pushing into daily highs and advancing higher. And on the opposite side, in the first part, the price is not even able to reach the daily low. And at the second part, here we have rejections at the daily low. So the price is moving into the low of yesterday, pushing higher. Moving into the low of yesterday, pushing higher. Moving into the low of yesterday. And here we want to be very careful and observe, can a price be rejected as well again here? Or is the price staying below the daily low and advancing to the downside? Like what we have seen here. If the price is able to stay below, or in this case above the daily high, that's how an uptrend unfolds. If the price is able to stay below the daily low, then that's a downtrend that is unfolding. But here at that point, we still have more bullishness because the market is rejecting the daily lows only. We could also draw a flag pattern using trend lines, but the most important part here is the rejection of the daily lows that we have seen here and here in this bearish wave. And again, we have the rejection here of the daily low. So we have 3 consecutive rejections at the daily lows. 1 here, 2 here, and now the 3rd one. And at that point, that's where you want to go long and trade here into the trend continuation direction.